Welcome to Introduction to Multifamily Syndication Part 1. In this course, we'll give you a clear and straightforward understanding of multifamily syndication. Whether you're new to this or have some experience, we'll break down the basics and equip you with the knowledge you need. This webinar is for educational purpose only. The information provided is general and not a substitute for consulting with qualified accountant or tax consultant. So please double check everything before you make a decision in any financial or any financial decisions that you'll ever make. Before we begin, I'd like to introduce to you to our company, BILAJ Capital Partners. We are a company focused on helping our partners achieve financial freedom through passive real estate investments. We prioritize deep market analysis, employing data-driven strategies to identify opportunities and mitigate risk. But it's not just about numbers, it's about building meaningful relationship with our partners, investors, and the community. Trust and growth are at the heart of our approach. Hello, my name is Mary Cardenas, the founder of BILAJ Capital Partners. My mission is to guide our partners in understanding data driven real estate strategies for multifamily investing. With over 15 years of experience in the tech industry and with multiple real estate investment, I bring a unique perspective in the world of real estate. Outside of work, I believe in balanced lifestyle that blends work, fun, and family. Activities like hiking and quality time with loved ones are my true wealth in my life, and I inspire the value to hold dear at Village Capital Partners. I'd like to extend a warm welcome to you for this webinar, and my hope is that you'll find this insightful. Let's get started. Just for an overview, here are the few things that we're gonna go over. We're gonna go over the multifamily real estate. What is the syndication and why it matters? Also, we will talk about the benefits and risk of multifamily syndication. And lastly, we'll talk about how to get started and setting a clear investment goals. For multifamily real estate, here are a few things that we need to go over. Steady income. With multifamily properties, it provides a consistent stream of rental income, making them a reliable source of cash flow for investors. It is also a resilience in economic downturns. Often it demonstrates more resilience during economic downturns compared to any other real estate types. For example, during 2008 real estate crash, many found themselves bouncing out of their single family home, but the demand for real estate units as a rental continue as people need a place to live. The other part of this one is the scalability. Investors can scale in their portfolios by acquiring multiple units within a single property or diversifying across various multifamily properties, increasing their potential for wealth accumulation. Diversification is also part of it. It offers diversification within the real estate sector, reducing risk by spreading investments across multiple rental units. For instance, if an investor puts all their capital into a single family home, they're exposed to the risk associated with that specific property. Compared to a multi family property with multiple rental units, the investors spreads the risk. Even if one tenant faces financial difficulties or a unit becomes vacant, the income generated from the other units can help offset the loss, thus providing more stable and diversified real estate investment portfolio. Strong appreciation potential. Usually multifamily properties located in growing markets can provide or can appreciate in values over time, providing potential capital appreciation in addition to rental income. One benefits that is dearly close to me is the tax benefits. Investors may potentially benefit from tax advantages, including depreciation deduction. Also, there's an options to do a hands-off investment. This the investing in multifamily allows you to benefit from real estate ownership without the hassle, without the day-to-day responsibility of property management. For example, we have a team of professional property management team that are responsible for the day-to-day operation of the property. These include tasks such as tenant screening, rent collection, maintenance, and handling emergencies. As an investor, you can enjoy the passive income from rental payments without being directly involved in the property management task. This hands up approach is particularly appealing to those who do not want to invest significant time and effort into managing properties. So let's say you're interested in investing in multifamily real estate, but have a busy career and don't have the time or expertise to manage the property. You decide to invest in multifamily deal. In this scenario, you become a capital partner for the syndication along with other investors. General partners or sponsors build a relationship with brokers, underwrite the property, negotiate the purchase price, run the due diligence, and acquire and manage the assets for you. A professional property management company oversees the multifamily on your behalf. The team handles tenant matters, property maintenance, and other operational tasks. You, as a passive investor, receive the share of rental income and any profits generated by the syndication without the need to actively manage the property. Your involvement is primarily limited to periodic updates and decision made by the syndication management team, allowing you to enjoy the benefits of real estate ownership without the hands-on responsibility. Let's talk about the growing rental market. Investing in multifamily properties allows investors to contribute to building and enhancing communities, providing quality housing options to residents. On the inflation hedge, real estate can serve as a hedge against inflation as rental income and property values may increase with rising prices. These factors highlights the relevance and attractiveness of apartment real estate as a valuable investment options in today's market. Let's dive into syndication real estate, the definition and its structure. So, real estate syndication, it is a strategy where multiple investors pool their financial resources and expertise to collectively invest in and manage a real estate property or portfolio. On the structure side, it involves experienced individuals known as sponsors or general partners. It also involves identifying, acquiring, and managing properties. While the passive investors provide capital and share in the profits and risk, this creates a mutually beneficial agreement. So, why is syndication a powerful investment strategy? It allows us to have access to larger investments. And there's actually a potential more profitable real estate deals that they may not even be able to undertake individually due to capital limitation. Investors can diversify their real estate portfolios by participating in multiple deals across different property types and geographic location, thus spreading risk. Deals are often led by experienced sponsors who bring expertise in property acquisition, management, and market knowledge, reducing the learning curve for passive investors. Investors can also enjoy the stream of passive income from rental properties without the day to day responsibilities of property management. Sharing financial risk and responsibilities among multiple investors can help mitigate the individual risk as losses and challenges are shared. Let's deep dive on the economies of scale. This type of structure often benefits from the economies of scale, reducing costs and improving efficiency in property management. Let's say an example. Multifamily syndication typically involves the acquisition of larger multifamily properties with multiple units. The larger the property portfolio, the more potential for economies of scale. And with multiple units under one management structure, expenses such as property maintenance, repairs, and administrative costs can be shared among the investors. This lead to cost saving per unit. Syndication often employ professional property management that specialize in multifamily properties. These management firms have the expertise and resources to efficiently handle a larger number of units. For example, consider a real estate syndication involving 200 apartment complex. Here's how economies of scale can come into play. Instead of hiring separate property managers for individual units or smaller properties, we can hire a single property management company to oversee the entire apartment complex. This centralized management approach is more cost effective as the management fees can be spread across all the units, reducing the per unit management costs. Another example is maintenance and repairs. Maintenance and repair expenses can be significantly lower per unit in a larger apartment complex. For instance, if there's a need for a roof repairs, the cost per unit is much lower when we spread across 200 units compared to a 10 unit property. Administrative tasks like accounting, legal compliance, and tenant communication are also streamlined when managing a larger portfolio. We can leverage technology and system to handle this task more efficiently, reducing administrative overhead. When it comes to supplies, materials, and services, such as landscaping or security, buying a bulk for a larger property can lead to cost saving. So in this scenario, the larger the size of the multifamily properties enables all of us to benefit from economies of scale, resulting in reduced operating costs, improved efficiency, and potential higher profitability for both sponsors and passive investors. All right, let's talk about the passive role. Passive investors can enjoy the benefits of real estate ownership without the time and effort required for active property management. These factors collectively make real estate syndication a powerful investment strategy that allows individuals to leverage their resources, expertise, and network to achieve their financial goals and participate in real estate market effectively. Now, let's talk about risk and mitigation. Potential risk in real estate and understanding how to mitigate them through property planning and some risk management tips. Market fluctuation. Real estate markets can experience price fluctuation due to economic factors affecting property values. For example, interest rates. Changes in interest rates can impact real estate prices. When real estate increase, it becomes more expensive for buyers to finance their property purchase. Higher rates can reduce overall demand, potentially causing property values to stagnate or decrease. Conversely, when interest rates are low, borrowing costs are reduced, and this can stimulate demand and increase property prices. For example, 2 years ago, that is 2021, the interest rates went down, and a lot of companies purchased multifamily properties at a lower interest rates. However, a lot of them didn't anticipate a new increase of interest rates, and some of their loans, such as any loans that are fluctuating, um, will end up getting a higher interest rates in the next month or in the next year. So what's that going to do is that we're going to be able to find some properties that may potentially be a distressed properties. They would have to sell the property because they weren't able to oversee the high interest rate. So those are the things that are very important for us and investors to understand on how the market fluctuation may potentially affect the investment that we put in. Supply and let's go over the supply and demands as an example for market fluctuations. So, economic factors have the potential to shape the balance of supply and demand within the real estate sector. For instance, in the context of COVID-19 pandemic, we've seen a shortage of supplies needed for property renovation, and this lead to project delays, consequently affecting the market rent's growth rate. This situation occurred due to reduced availability of renovation materials and labor, which in turn impacted the overall supply of renovated properties and influenced rental market trends. In these examples, it illustrates how economic factors can influence the real estate market and result in price fluctuation, making it important for investors to monitor economic conditions and trends when making real estate decisions. So, how do we mitigate through proper planning? One is to diversify. Invest in different markets or property types to spread risk and reduce the impact of market fluctuation. Reserve funds. We have to maintain adequate reserves to cover unexpected expenses and vacancies caused by tenant issues. Thorough due diligence. We have to make sure that we conduct comprehensive market research and property inspection before the acquisition to identify potential issues. Tenant screening. We have to implement strict tenant screening processes to minimize the risk of problematic tenants. We also need to hire experienced property managers to handle tenant issues and property maintenance efficiently. Some of the risk management tips, stress testing. We evaluate the impact of various market scenarios on your investment to prepare for potential downturns. When you are presented with a deal as an investor, make sure that you ask questions such as, if the deal has been stress tested and at what capacity that it's going to allow each and everyone to continue to make profit at and in what condition. So please do ask any of those questions, making sure that in any scenarios the general partners or sponsors have taken into consideration to make sure that the investment is actually a good investment regardless of what's happening in the market or what's happening in the economy. Cash flow analysis. We got to make sure that positive cash flow, even in challenging circumstances, to cover operating costs. Insurance. Secure appropriate insurance coverage, such as a property and liability insurance, to mitigate financial risk. Legal protection. We utilize solid lease agreements and legal safeguards to protect your interests in case of tenant disputes. Regular inspections. We conduct periodic property inspection to identify and address maintenance issues promptly. Emergency funds. Make sure that maintain of emergency we maintain emergency funds separately from operating capital to handle unexpected expenses. Also, stay informed, stay updated on market trends and economic indication to make informed investment decision. Make sure that once you're invested in a property, your partners, general partners as well as sponsors, will continue to update you to be informed in anything that is happening in the market, in the economy, what indications that they're looking at to make sure that the investment are still a sound deal. So, by understanding and proactively addressing this risk, real estate investors can better protect their investment and improve the likelihood of success in the long term. Always find a partner that you will feel comfortable asking all of these questions, and you know that before you get into any specific deal, that all of this has been answered, and you have been you ask that questions to them as well as it has been addressed. All right, let's talk about key points on how to get started by setting clear investment goals. So, having the direction and purpose, clear investment goals provide a sense of direction and purpose, helping investors stay focused on what they want to achieve. Make sure that you talk about risk mitigation. Well defined goals help investors make informed decisions and mitigate the risk of impulse or emotional investment choices. Few things that you can go over to kind of like a step-by-step process for setting clear and achievable goals. One is self-assessment. Reflect on your financial situation, risk tolerance, and investment timeline. Consider your short-term and long-term financial objectives. Specific goals. Make your goals as specific as possible. For example, instead of vague goal like build wealth, specify if you want to generate $5,000 a month in passive income through real estate within the next 5 years. Something similar to that, so that once you have that specific goal, you know exactly what type of deal that would best fit for you and what type of deal that will best bring you to the goal that you're looking for. Another one is to be able to measure your objectives. Figure out how you will measure progress. Use quantifiable metrics such as income targets, property acquisition milestone, or net worth goals. Achieve achievable targets. Set some realistic goals that align with your resources, time commitment, and risk tolerance. Ensure they are attainable within your financial means. Relevancy to your life. Ensure your goals are relevant to your life and financial aspiration. Consider how achieving these goals will impact your lifestyle and future. Time bound deadlines. Establish specific deadlines for your goals. Having a time frame creates a sense of urgency and help you stay accountable. So by following this step-by-step process and using investors can set clear and achievable investment goals that guide their real estate syndication journey effectively. In conclusion, in this session, we covered several key points, an overview of multifamily real estate. We discussed the significance of multifamily real estate in today's market. We highlights its steady income potential, resilience during the economic downturns, and the growing demands for real estate properties. We also did some definition of syndication. We defined real estate syndication as a strategy where experienced sponsors acquire and manage properties while passive investors contribute capital and share profits and risk. So we also talk about the benefits and risk. We explored the benefits of multifamily, such as access to larger investments, diversification, and passive income. We also discussed potential risk, including market fluctuation and tenant issues. We also went over some ways to mitigate risk. We provide strategies for mitigating this risk through proper planning, including diversification, maintaining reserve funds, conducting thorough due diligence, implementing tenant screening process, and utilizing professional property management. We also talk about setting clear investment goals. We emphasize on the importance of defining clear and achievable investment goals as a foundational steps in real estate deal. These goals provide direction, help measure progress, and mitigate risk. So, in conclusion, I hope this give you some insights of what the real estate syndication is about. It's crucial to understand the basic of multifamily deal before diving into investment strategy. This foundational knowledge equips investors with clarity and preparation needed to navigate the multifamily real estate successfully. I'd like to thank you for your time. And if you have any questions that you may have, please feel free to reach out. My email address is there, mary at bilajcapital.com. My phone number is there as well as the website. Looking forward to our next webinar. We're going to talk more about all the details on how to find deals. So please stay tuned. Our new webinar will always be dropped off every week. So thank you, and I wish you well, and I hope to see you all again.